So you've warned about the impact of coronavirus. Can you give us a little bit more detail on where you see the biggest touch points for your business?
Yes, so last year, we just announced the numbers today. I think we actually had a really good performance. It was very resilient, given that there were a lot of things going on around the world, the China-US relationship, the unrest in Hong Kong. We still got our numbers up. Our bottom line was up 10%. So I think we were very pleased with how resilient the business was last year. Clearly, as we come into this year, new factors emerge, and the coronavirus, as you say, is very much on everybody's minds. We have actually seen for the first couple of months, actually, the business has performed very well, although clearly the impact of that will probably come through in March and beyond. I think the uncertain feature at the moment is in which markets it will affect things. China appears, touch wood, to maybe settling a little bit. Obviously, outbreaks in other countries, we'll have to see how long those go. So we have, off the back of that, just cautioned that this year may be a little bit more challenging. Time will tell how challenging it is, but we will continue to do what we've been doing before. Some things we can influence, some things we cannot.
Andy, indeed, the known knowns and the known unknowns. Let's talk about credit losses. The risk to the business comes in the form of non-performing loans and credit losses. We saw HSBC give us a number last week in terms of what they expect. What can you tell us about your expectation for credit losses and NPLs this year at the moment?
So if I step back, the overall non-performing loans in the business are at the lowest proportion of our total book that we have seen for about 5 years. So the general quality of the book is really, really good. And the trend, if one goes back over the last 2 or 3 years, has been on an improving trend. During that period, we obviously monitor things that are happening, and at the moment, impacts from things like the virus, we are keeping a very close eye on. I think it's very difficult to actually provide quantification of this at this stage. What we have said is the first 2 months started well, as I just said, that March is likely to have some impact. And clearly, when we get to the end of the first quarter, we'll take a view as to what sort of inherent risk there is in the credit book. But I just think it's a very difficult one to put a precise number at this point in time.
Yeah, appreciate it's difficult. I mean, what we heard from HSBC is that the outbreak could lead to as much as $600 million in additional loan losses if it continues into the second half of the year. Is that a sort of ballpark amount that you'd be looking at as well, even if you can't put a precise number on it?
I think it is very difficult to say. Their business is clearly a much bigger business than ours. Our hope would be that this would not be a material event for us. And our hope equally would be that over a period of time, if we do top up the provisions, as this recedes back, those provisions will be reversed. So no guidance on the numbers. We will see where we get to at the end of the first quarter.
So, Andy, a couple of things. Let's go to the good piece of news, which is share buyback, $500 million. However, the market was looking for $1 billion. That's what was penciled in. Why not a higher share buyback, and when might you up that number?
So the good thing is that we are now doing buybacks, and buybacks plural. So we did our first one last year, which was $1 billion, and that was the first buyback we've done for a very, very long period of time. We said that if we got to a point where we were actually building and we had sufficient capital that we could do further returns, we would do that. I think the market actually was in two views as to how much and when we would announce something. And hopefully the fact we've done the announcement today of $500 million will show that we are continuing to live to that promise. And as we have excess capital, we will continue to return it. So I think it should be seen as a sign of strength of the business, the fact that in difficult times it has got very good capital levels. It is very confident in making returns. And as and when we build further surplus, we will clearly have a look at what we can do again in the future. We have got the sale of one business, Permata, coming up, which has got the potential for further releases of capital when that actually concludes. So I think this is a step at a time, but $1.5 billion over the last year and a half or so, that's something like 5 to 6% of our total equity that will be bought back during that period. I think in the times we live in, that's a pretty good outcome.
Andy, the other thing the market's paid a lot of attention to, of course, is the return on tangible equity target. You had that target of 10% by 2021. You've said that you're going to have to delay that now. Can you say until when? Can you give us any guidance on that timing?
So this time last year, we said 10% we absolutely believe is what the business is capable of, and we will endeavour to get there by 2021. What we're saying today is we still continue to believe very strongly that this is a business that has the capability to get to 10%. To put it in context, in 2015, we were negative on our ROTE. the numbers we just printed for last year, we were 6.4%. So we've come up 7 percentage points of that sort of 10 gap, and we are making good progress. Clearly, what has happened in the period since this time last year is the outlook for interest rates has deteriorated, the macro environment has deteriorated, and at the moment we've got the virus issues. And we've just said that is going to make it very difficult to achieve it in the 2021 timeframe. We will still absolutely be gunning for it, but we now believe it will take longer than 2021 to achieve it.
Can we talk about the response mechanism, Andy, that we've seen, for example, in Hong Kong? In recession, protests, coronavirus, that's the backdrop. I look at what they've done. Hong Kong, 5% of GDP in terms of a budget. Singapore, 2%, and more to come, we expect, from other nations. The response that you saw from Hong Kong yesterday, is that the right response? And do you think that that will put a floor under the Hong Kong situation?
I think each country is having to feel its own way through this, and it's not that there is one right response that will encompass all countries. But I think what Hong Kong is doing is proactive. They are moving forward. They are taking actions. They are trying to help people. We are being sympathetic with our customers where we know that there are challenges that are caused by the current situation. And I think generally governments are behaving very thoughtfully in this. Clearly, it is a very difficult one. The invisibility of the underlying problem is the thing which I think vexes a lot of people. But I think what each country is doing so far does make sense. And we hope that that does help and it does keep the confidence in the economies as we work through this period.
Banks globally have been taking all kinds of contingency measures around coronavirus, Andy. What are you putting in place right now? Because you have outlined there's a lot of uncertainty. You can't give exact numbers around additional loan losses. There could be more provisions. Where's the contingency planning? Is it in provisions? Do you have a number for that? Is it around human resources? What steps are you taking?
I think the biggest impact actually has been our people and our clients. We have got a lot of people who are employed in China and in Hong Kong particularly, and their lives have been affected by this hugely. And we have been as supportive as we possibly can be and being very sympathetic to what is happening. Looking after clients who will find the current environment more testing and looking at what we can do to help them, I think by far and away is the biggest area of focus. The sort of numbers will follow, but I think at the moment this is about people and it's about the impact upon our employees and our workforce.
Can I ask you about the leadership? There's a lovely quote. You're quoted this week. It's lovely to quote somebody else back in another source in the FT, denying that Bill Winters has checked out of his Standard Chartered CEO job. Look, we've got a huge amount of change. What makes you stand so strongly and resolutely behind that? How long do you think that he will stay? Why do you make such a strong statement and rebuttal?
We have been, Bill, the management team, on a fascinating journey over the last 4 or 5 years as we have nurtured the business back to rude health. And we all know that the journey is not finished, particularly the financial target, the returns on equity. We're not yet at the 10% level that we believe we can get to. And I think we are just very committed to now making sure we take the next steps to actually get to that level. And the commitment of the management team, the commitment of the management team to actually get to that is absolutely undoubted. And we see a tremendous prize at the end of that of actually getting to double-digit numbers.
I'll let you take a drink of water, Andy. Sorry, I don't mean to labour the point, but on that return of tangible equity, as you brought it back again, and you say you're absolutely committed, if it's delayed, you can't reach it by 2021. How much of a delay are we talking? First half of 2022, further into 2022, further out? What kind of guidance can you give the market on that today?
So key things to my mind, 10% is absolutely what we believe in, and there are lots of points of reference in the markets we operate of banks to achieve much more than that. So I think there is no doubt that that is where we can get to. The timing is tricky. Some of this is within our control. A lot of this is not within our control. If somebody can say to us when we'll see some sort of pickup in interest rates, when the macro outlook will be better, when the virus will finish, it will be much easier to put timelines to it at that point in time. So at the moment, we're saying it's later. We'll get there as fast as we safely can. We're not going to take shortcuts to just get there on a date, and we'll see exactly where it pans out. But 10% is where we will get to.
OK, Andy, that's the objective. That's the high-level objective, and we get that. We've seen restructure after restructure at a number of banks and stepping back from return on equities. How far away from, if you don't make that 10% return on equity, you've either got to raise your revenue or cut your costs. So is there another potential overhaul or restructure in the pipeline?
I get back to my previous point. The restructure that we announced back in 2015, that has really been contributing. We've now got our return on equity 7 percentage points higher than it was only 4 years ago. So I really do think that the medicine is working. We just need to really stick to what we are good at. We need to understand that the external factors will create some challenges from time to time, but I don't think that should deter us from our core thesis. We're growing our network very strongly. We're growing our affluent customer base very strongly. We operate in many of the fastest growing markets in the world, notwithstanding what is happening at this point in time. We feel very comfortable that we're on a good track.